Good afternoon, everyone. My name is Venki Venkateshwaran, and I'm delighted to welcome you all to the 24th NYU Stern Economic and Market Outlook Forum. The host of today's forum is the Stern Center for Global Economy and Business, which serves the university through outreach to the broader community, including the academic, business, and policy worlds, as well as students and alumni. We're pleased to have in the audience today students and faculty from all over NYU, as well as many alums. Thank you all very much for joining us. Today's session will last about 90 minutes. It will begin with short presentations of about 10 minutes each by each of the panelists about economic and market prospects, followed by Q&A. We'll finish by 6:30 p.m. To ask questions, please enter them through the Q&A feature in Zoom. You can enter them throughout the session. While moderating, I will try to limit repetition by grouping similar questions and posing them to the three panelists. Given the severe time constraint, I apologize in advance. We may not be able to take up all your questions. Let me now turn to introducing our distinguished panelists. Our first panelist is Mark Giannoni, who is Managing Director and Chief Economist at Barclays Capital. Prior to joining Barclays, Mark held positions at the Federal Reserve Banks as Senior Vice President and Research Director at the Federal Reserve Bank of Dallas and Research Economist at the Federal Reserve Bank of New York. He was also an Associate Professor at Columbia Business School. He began his career as an economist with the Swiss National Bank in Zurich. His research focuses on broad macroeconomic and policy issues, including monetary policy strategies, transmission, interest rates, inflation determination, and labor markets. While at the Fed, he co-led a team that developed the analytical work underlying the review of the Federal Reserve Monetary Policy Framework released in August 2020. Welcome to the forum, Mark. Our next panelist, Dr. Karen Kimbrough, is the Chief Economist for LinkedIn, where she leads a team devoted to surfacing thought leadership on the world of work. Prior to joining LinkedIn, she served as the Assistant Treasurer for Google and the Head of Macroeconomic Policy at Bank of America. In addition, Kimbrough has worked at the Federal Reserve Bank of New York in the markets group for nearly a decade and as an economist and FX strategist at Morgan Stanley in London and New York. She currently serves on the boards of Fannie Mae and the Federal Reserve Bank of San Francisco and is a member of the board of directors at the NBER and CEPR. She holds a bachelor's from Stanford University, a master's from Harvard, and a PhD in economics from the University of Oxford. Welcome, Karen. Our third panelist, Liz Ann Saunders, has a range of investment strategy responsibilities at Charles Schwab, where she's managing director. She's been a keynote speaker at numerous company and industry conferences. She's regularly quoted and appears frequently in the financial press. She's been named Best Market Strategist by Kiplinger's Personal Finance and one of Smart Money magazine's Power 30. Barron's has named her to its 100 most influential women in finance every year since the list's inception. An investment advisor has included her on the IA25, the list of 25 most important people in and around the financial advisory profession. She's also been named to the Forbes 50 over 50. Prior to joining US Trust, which was acquired by Schwab, Liz Ann was a managing director and senior portfolio manager at Avatar Associates. She holds an MBA in finance from the Gabelli School of Business at Fordham and a BA in economics and political science from the University of Delaware. Liz Ann, welcome to the panel.
Thank you.
So now I'm going to hand over to each of the panelists to speak for their brief introductory remarks. We're going to start with Mark, followed by Karen and Liz Ann. Mark, whenever you're ready, the floor is yours. So the screen is yours.
Thank you very much, Venki. It's a pleasure to be here and also with these distinguished speakers around me. So let me share a few slides maybe to provide some background here. I don't know if you can see that. I was going to talk about our US economic outlook and talk about why we think that this is really dependent on the evolution of inflation. If I can move this forward. All right. So a few themes here. If you look back just over the last 6 months, activity grew very, very strongly in the US. We had nearly 5% growth in the third quarter. We had over 3% real growth in the fourth quarter. And this is at a time where, most forecasters about a year ago were expecting that we would see quite a bit of a slowdown in 2023. So instead of that slowdown, we got quite a sharp acceleration in activity in the second half of the year. And that growth was largely supported by consumer spending. So the key here, I think, is understanding what happens to the consumer. Why is consumption still so resilient? I think part of that has to do with the labor market. And that's my second point here. If you look at the labor market, it looks like by most measures, it remains pretty tight. Maybe it appears to be easing, but if so, very gradually. I'm sure I'm looking forward to hearing what Karen will have to say about that, because she has certainly a lot of information about this. The labor market, we think, it continues to fuel self-sustaining gains in aggregate income, in spending and hiring. And I think the way I've been describing this for a little over a year now is that I think we have a pretty strong feedback loop between consumption and the labor market. And the way that works is, firms keep adding jobs month after month after month. With these jobs come additional income. This income fuels consumption. The consumer turns around, buys all sorts of goods and services. And in doing so, they maintain the labor demand pretty strong so that firms keep adding jobs. As a result, firms are trying to produce more to meet the demand. They are not always able to meet the demand and therefore are forced to raise prices. So we've seen a lot of inflation in 21 and 22. This has come down since, but overall, core inflation has come down substantially in the second half of 2023. But it remains still quite elevated if you look at CPI. It has come down a lot more when you look at the Fed's favorite measure of inflation, the PCE inflation. So then that brings us to the Fed. Then, what do we think the Fed is going to be doing? So the Fed, we think, will need to maintain a fairly restrictive stance of policy until it gets really confident that inflation can return sustainably back to 2%. And there is the tricky part of it is trying to figure out, first of all, what does sustainably around 2% mean? If you look at different indicators, you get different answers. We think that based on the PC inflation, the Fed looks like it is already at 2%. If you look at indicators like the CPI, for instance, it's closer to 3%. So maybe just a few charts to highlight the points I've made. If you look at GDP growth here in the second quarter of last year, third quarter of last year, shown here, nearly 5%, 3.3% in the fourth quarter. We expect to see 3% in the first quarter of this year. So still very robust growth, most of it driven really by this consumption. You have a little bit of support from fiscal policy. We can talk about that maybe in the Q&A, but there is some positive support from that. But really, the large part is coming from consumption. What's going on with consumption here? I think this chart to me says a lot. If you look at real income in the US from 2018 until now, you see real income growing at about trend in 2018, 2019. And right when the pandemic started, we had a huge increase in income. We had here this big spike in 2020 in April with the CARES Act. We got then some additional support in January 21, then in March 21. In all of these cases, this was a lot of fiscal support. Without the fiscal support, we would have had this light blue line here that would have shown a sharp decrease in income. We didn't see that. In the aggregate, household got a lot more income than would have had we not seen the pandemic. And then since then we've had income in real term continuing to grow pretty steadily, especially since inflation has come down. We see real income gains, and these real income gains continue to support consumption going forward. How much more consumption can we have? Well, I think one way to look at that is to look at how much we have saved. And this chart here on the left shows you the personal saving rate for the typical US household. The US saving rate is now very low, below 4%. And in fact, there are only a couple of other episodes in recent economic history where we see saving rates that are as low as that. One is here, 2005, 2007, during the housing boom, when people were extracting equity from their homes. They didn't feel like they had to save much. They could just consume a lot. The other episode not shown on this chart here is prior to 2000 in the dot-com bubble, when people were extracting basically feeling very optimistic about the future due to the stock market. I think this time is really because households have accumulated a lot of savings in the 2020-2022 period, in large part due to these fiscal transfers. So we think these households still feel quite wealthy. They can afford to consume a lot now and spend basically these accumulated savings. There's a whole debate about how relevant these accumulated savings are. We estimate that to be at about excess savings about $1 trillion accumulated. Now, this is only a small fraction of overall household wealth, but it's still something that we think is helping support consumption. I mean, if there are questions, I can come back to household wealth. But then quickly, the interaction with the labor market. I'll be very quick on that because I suspect Karen will talk a bit about that, and Lizanne as well. Quickly on that, I think what we are seeing is some moderation on the demand for labor on the part of firms. One way to look at that is look at how many job openings we have out there, and in particular, how many job openings relative to the number of unemployed. We have about 1.4 job openings per unemployed at this point. This is much less than we had about a year ago when we had 2 job openings for each unemployed. So it suggests that firms are really not looking for as many workers as was the case before. But it's still a lot more than we had back in 2018, 2019, when we thought we were at full employment. So it looks like by this metric, at least, the labor market is quite tight. There's still a lot of demand for workers, and in particular, in a range of services that you can see here on the right, like health services, professional business services in leisure and hospitality or transportation, for instance. On overall, this demand still being quite strong, I think supports a lot of job gains. We've seen the payroll report last week show us incredibly strong number for January, also a very strong number for December. We create over 300,000 jobs now. On average, over last year was lower than that, but still, more than 200,000 jobs that we are creating each month. And as I said, with each of these jobs come more income and more support for consumption. So by looking at the unemployment rate, labor market is, of course, very tight as well, with the unemployment rate at 3.7%. And on the supply side of labor, I think we've seen some increase last year with an increase in the labor force participation, this dark blue line here, that increased pretty significantly, especially for the prime age workers. We saw a large increase in labor force participation. There was some hope that there would be some easing of labor market tightness coming from the supply side, but I think in the last few months that has reverted. And so I think it doesn't look like we can hope for much more sharp increase in labor force participation, certainly not from the prime age workers. Let me skip that. The last point I want to make has to do with inflation. If you look at the behavior of CPI inflation, I guess everybody is familiar with that. The part I think that's really interesting is that we had some part of inflation that was really transitory, and that's the whole goods inflation. If you look at here, I separate CPI in terms of core goods inflation and core services inflation. The core goods inflation was mostly deflation for all of the decade prior to the pandemic. Then we got, these supply chain disruptions, material shortages that led to a sharp increase in inflation. But as soon as the supply came back online, the inflation came back down, and now we are again running at fairly low or negative inflation rates on the good side. The part that's more concerning is what happens on the services side. And here we've always had, in the decade prior to pandemic, inflation around 2.5%. With the shortage on labor, I think we got a pretty significant increase in wage inflation. We also got increase in price inflation, certainly for the services side, which are more labor intensive. And that is reverting somewhat. Part of it is housing, but part of it is also the wage inflation and the overall services price inflation in other than housing. But it's still, to this point, it's still looking like it's more elevated than was the case prior to the pandemic. So I think there is some concern to have here on the CPI side. The problem on inflation, as I alluded at the beginning, is that it really depends on which metric you're looking at. And in particular here on this chart on the left, I'm showing in the very dark line, this is the core PCE inflation, so the Fed's favorite measure of inflation on the 6-month annualized rate. If you look at that over the last 6 months, it's basically 1.9%. So essentially at the Fed's target. So looking at just this black line here, you would think that the Fed's mission to bring inflation back to 2% is accomplished. Okay, so that is what has triggered a lot of the calls or expectation that the Fed will cut rates pretty soon. The problem with that is that the Fed cannot be very confident about inflation staying at that low level. In fact, we forecast a little bit of a firming going forward on the PCE inflation. The reason for that is that if you look at a bunch of other indicators like CPI and then a range of other indicators in this gray zone here, they are all higher than the core PCE inflation. And so there are some reasons to be concerned about the inflation when you look at these other measures, and especially when you see that the labor market is so tight and consumption continue to be so strong. All right. So then finally about monetary policy, the Fed began its tightening campaign in March 2022 by raising rates very, very sharply. In July of last year, it implemented its last hike of 25 basis points, brought the rate target range to 5.25%, 5.5%. But it kept a tightening bias for the most part until this last meeting in January, when it removed the tightening bias and now stated that basically it does not expect to reduce the target range until it has gained greater confidence that inflation is moving sustainably back to 2%. What does that mean for us? We expect that the Fed may well start cutting rates in May of this year, then June, and then every other meeting after that. The conditions we think need to be fulfilled for that to happen is that core PCE inflation remains weak in the next few months, and the economy is gradually decelerating in the next few months. If we don't see that, we think there's a risk that the Fed will postpone the first cut to June, but that it will start cutting sometimes later this year. Again, assuming that the economy is gradually slowing and that inflation is coming down. So that's, in a nutshell, our outlook. We expect activity to gradually slow, the employment to gradually moderate from what the high levels where we are now, and the unemployment rate to move up a little bit, inflation to decline a bit. So basically a perfect soft landing here with the Fed starting to cut rate later in the spring.
Thank you so much, Mark. Just a quick reminder to everyone, if you have questions, please type them in the Q&A box at the end of the panelist presentations. I will curate them and present them to the panelists. Karen, you're up next. So whenever you're ready, take it away.
Hi, everyone. Thank you for the opportunity to come and join this panel. I'm coming to you from LinkedIn. I decided not to show charts, so I'm going to just kind of briefly give you a little tour of the data as we see it right now. We look at a range of things. So I'm going to start with hiring. We're able to see across 1 billion members at LinkedIn globally what their career profiles look like, what their skills are, where they have a job, and so forth. And we're also able to look at measures kind of interest. So are they looking at jobs? How many times do they view a job? How many times do they view a job before applying? How many applications do they make on average? And so that gives us a sense also of just sort of eagerness or intensity of search, which I think is a nice early hint at whether or not the labor market is, turning. You'll recall, of course, that there was a moment at which everyone kind of sort of stepped away a little bit from looking, and it probably was related to all that really active fiscal policy we had that Mark mentioned. And then there was a point at which the employers were competing with each other to hire. That has, evened out. And really where we are now is looking at a labor market that is gradually slowing, but it's still quite stable. And by that, I mean that hiring has stabilized a lot. The rate at which people are telling us, hey, I got hired for a new job, is actually unchanged since about the middle of last year. It's not that case for every single industry, but overall, hiring has leveled out after having slowed. The pace of hiring had slowed a lot. So it's not that fewer people are being hired, it's just that the pace at which people are telling us they're getting hired is not as rapid as it was, say, 2 years ago. Now, it's a slightly different story in the tech, what we call the tech, the information sector, the media sector. That really went through a recession beginning in late 2022. And I would say since about the middle of last year, that's actually begun to improve a little bit in the sense that it's no longer in free fall, where hiring has slowed and continued to slow and is down so substantially. Hiring is kind of leveled out. It is not at the pace at which it was, say, a year ago or 2 years ago, but it is still not falling as much as it was before. So the way I think about it is tech was in a pretty deep hole. It stopped digging its hole. It hasn't yet come out of that hole. But if I think step back overall across all industries, hiring is now running about 10% slower than it was a year ago. But on a sort of like month-to-month basis, we are seeing now gains in hiring in the last couple of months, which suggests to us largely that the labor market is strengthening, not, I won't say strengthening, but stabilizing from a point at which it was like easing really, really rapidly. It's now easing a little less rapidly. That's really on the sort of hiring front. When we look at what employers are telling us, so we can see job postings across some 65 million companies that are part of LinkedIn. And at any given time, there might be 14, 15 million jobs on the platform. We can see that there are still plenty of jobs on the platform, but they're definitely not as many as before, and they're not growing as quickly. So there's also a sort of stabilization, if you will, in what you might call the demand for labor side. So that is definitely moderated, as Mark said. And we see it. There was a point maybe a year and a half ago where there were 2 jobs for every job seeker, and now that's reversed for us, where there's really 1 job for every 2 job seekers. And that's not so much that there's like so many fewer jobs, it's also that job seekers in our mind have come back and are looking more eagerly. So what I mean by that is we do see that when someone is coming on the platform and they're looking for a role, they're actually looking at maybe as much as 30% more jobs than they did in the past. So they're looking more broadly and applying more broadly on average to more roles than they did a year ago or 2 years ago. And that's quite significant. That kind of tells us that the labor market is not only sort of gradually stabilizing or slowing, if you will, from a really sort of hot, tight pace, but it's also rebalancing in many ways in terms of the evenness between competition, between employers and job seekers in terms of who's looking. If we think a little bit more about just sectoral, there are sectors that have been pretty resilient through all of this, and that probably comes as no surprise when you think about the macro story. So one is healthcare, which obviously was extremely resilient during a pandemic for obvious reasons, but has remained so. We see a lot of hiring activity in healthcare, a lot of hiring activity still in government, which is interesting, but I think that's a little bit of a counter-cyclical offset to some slowdowns we saw in the private sector. There's also a lot of additions in manufacturing, which makes sense as well when you think about all of the fiscal support that's going into creating more manufacturing jobs, more investment and subsidies for investment in manufacturing in the US. So it's actually showing up a lot through construction and manufacturing in our data. Some of the sectors that have been a little bit more sluggish recently in the past, say 6 to 12 months, finance, professional services, generally large companies, a lot more willing to take a pause before they hire aggressively. They are a little bit more picky about who they take. And that's probably also a counterpoint to where we were 2 years ago when there was a lot of really active hiring by a lot of companies. Obviously, tech is the poster child for this, but many, many other companies also were actively hiring or at least actively seeking talent. Let me take the last, maybe if I can, 4 or 5 minutes and talk a little bit about some other thematic things we see in our data that tell us a little bit about the scope of where the labor market is. And now I kind of think of these as like the fun popcorn elements of the data where we can ask kind of questions of it. So one is that when you look at certain aspects of the labor market, you can see whether or not people are choosing to leave their roles. I already mentioned that they're already looking more actively and applying to more roles than before, but we're also seeing transitions. So job transitions start to pick up. And that is really a sign that people aren't sheltering in place. I know quits can still seem low, but we're starting to see an uptick in job transitions where people are rotating around to new employers. And so that tells us that there's a little bit more optimism maybe coming in the job market, even as Mark pointed out accurately, overall activity, say in the US, is indeed slowing over the last few quarters. We're seeing people feel a little bit less panicked maybe or worried about there being a recession in the job space. We can track a couple of other trends I wanted to just maybe share. They're kind of fun. What we see in the hybrid remote space is that there was a point at which remote jobs went from about being 6% of the jobs on our platform to 20% of the jobs on our platform in the US. That has now dialed back. Employers are definitely scaling back their offerings of remote employment. What's interesting is that now maybe remote employment is somewhere around 10% for the US, as opposed to 20% at its peak. So higher than where we started pre-pandemic, but much lower than we were kind of in the midst of all of it a few years back. At the same time, remote is coming back. We're going backwards, so to speak. We're seeing hybrid pick up. So hybrid is now the flavor of the moment, although when you talk to employers, they're really keen to kind of start to see people back in at least 4 days a week. But right now, there's a tension between what employers are looking for and what job seekers are looking for, because job seekers overwhelmingly apply to remote roles. They're oversubscribed. There's a real appetite for remote roles that you don't see for hybrid. I mean, people are happy about hybrid, but definitely almost everybody applies to one remote role. So that's one thing I wanted to share. And then final 2 observations is we are seeing people move around. So one of the things we can see is where people are and where they've been, and migration patterns have shifted again. They shifted during the pandemic, of course, with everyone sort of leaving some of the big cities, going to places that are more affordable or maybe are lower tax states. We're now seeing people continue to migrate, but that's sort of bimodal. They're either migrating less than 25 miles, so maybe shifting around to a new job in a new space, or they're migrating over 3,000 miles. And that wasn't quite what we saw during the pandemic. During the pandemic, it was more like a couple 100 miles or more. But 3,000 miles suggests people are moving for jobs. They're not just moving to escape wherever they are. So definitely changes in the migration pattern. And then the last thing I'll say is some interesting observations that we've had really in very lately is there's a lot of focus on AI. I didn't want to come and like make it an AI talk, but we've done a lot of work on AI. Happy to kind of like answer questions, but I would say the upshot is that we're seeing so many roles now infused with AI. We've seen a 70% increase in new job postings on our platform in English that are looking for AI or generative AI expertise, and the fastest growing, I'll call it digital or tech skills, are all generative AI skills. Natural language processing, question and answering systems, prompt, recommender systems. These are all the fastest growing skills that we're seeing in the space right now, which is a huge change from, say, 2 or 3 years ago. So I don't think AI is a flash in the pan. I think it's here to stay, and it's starting really to permeate the job market. I will stop here and turn it back to you, Venki.
Thank you so much, Karen. Lizanne, you're on. So whenever
Great.
you're ready, take it away.
Thanks. And I'll key off some of what both Mark and Karen said, which was fascinating to listen to. I think that In terms of analyzing this cycle, nuances are really important. To say this cycle has been unique is the ultimate understatement. It elicits comments like, well, duh. But I think there's sort of a theme of dichotomies that help to explain this cycle. And it's a cycle that really can be viewed through the dichotomies of goods versus services, which I know Mark touched on. Top line growth versus bottom line growth, nominal data versus real data, soft economic data versus hard economic data. But not that any of us want to go back and rehash the last 3.5 years, but I think the start point is important to go to during the most robust stimulus era of the pandemic, when essentially the world was still in lockdown, but you had the rush of both monetary and fiscal stimulus. And at that time, of course, all that money and demand associated with was forced to be funneled into the good side of the economy because services were shut down. We had no access to it. And that not only was enough to pull the economy out of the short-lived, albeit painful COVID recession, it also became the breeding ground of the inflation problem with which we're still dealing, but very concentrated initially on the good side of inflation metrics. But then subsequent to that, particularly when services started to rebound, we had sort of met all the pent-up demand on the good side. So we actually went into recessions, into hard landings for manufacturing, for housing related, a lot of consumer-oriented goods and products. So we had recessions in those areas, hence the term we've been using, which is rolling recessions. You went from hyperinflation on the good side to disinflation to outright deflation in many categories. But we've had the offsetting strength in services in the economy, the offsetting later pickup in the services-oriented categories of inflation metrics, some of which by nature of what they are, like some of the shelter components, are stickier in nature. Services is a larger employer, helping to explain why the labor market has stayed afloat. So that's sort of the goods versus services dichotomy. Then you've had the soft versus hard data dichotomy. And some examples of that would be, and for those who aren't familiar with the terminology, soft data is survey-based data. So it's attitudinal in nature. The hard data is the actual, tracking of metrics and what is happening in the economy in actual terms. But if you sort of pair some soft and hard economic data, one would be consumer confidence or consumer sentiment, two different monthly metrics, essentially gauging the same thing, versus, say, consumer spending. You saw in the case of consumer sentiment, which the questions asked in that survey tend to gear a bit more toward inflation, hit a record low. Consumer confidence, not quite a record low, but a serious plunge, yet you didn't see the commensurate plunge in consumer spending. You could tie a soft metric like CEO confidence to corporate earnings. And although we did go into negative territory in corporate earnings, nowhere near to the degree that you would expect if you extrapolated the plunge that was seen in a metric like CEO confidence. And then, of course, nominal versus real data and top line versus bottom line as it relates to things like corporate earnings. And I think when we were in the surge in inflation, there were a lot of misperceptions about strength in the economy, about corporate earnings being strong, but the reality was a lot of pricing power, a lot of revenue growth was solely tied to inflation. And now we're sort of on the come down part of the cycle where we've got that top line growth coming down. That in turn tends to drive decision making around labor, and why you're again seeing a pickup in some of these high profile layoff announcements. The other interesting thing about this cycle is that where we've seen pockets of weakness in the labor market, when we have seen, moves up and things like layoff announcements, it's been quite a bit more top down in nature than bottom up, like is typically the case in past cycles, where especially when we had the real rash of tech sector layoffs, and then slightly more recently, especially tied to the mini banking crisis, financial sector layoffs, they were more top-down in nature. They were up the wage and income spectrum. They were into the managerial classes. That helps to explain the disconnect with metrics like initial unemployment claims, which doesn't seem to jibe with some of the other cracks that we've seen. But that's in part because this has been top-down in nature. So you've got many of these workers that lost their jobs either quickly found others, or they got severance, which means they're not eligible, or they might have plenty of the nest egg left, that they don't have to rush to the unemployment office. So I think that all of this data in this cycle, just you need to have your fine-tooth comb at the ready to really get a sense of what's going on. Thinking sort of bigger picture, I do think that one of the things that was maybe sped up by virtue of the pandemic, possibly would have happened anyway, is a shift to a very different secular backdrop than what we now think of as the Great Moderation era. Bernanke sometimes gets credit for that term. Larry Summers sometimes get credit for that term. Maybe it doesn't matter, but it's generally seen as the period from the mid to late 90s up until somewhat recently, kind of into the early part of the pandemic. And it was an era where I like to use the acronym GEL, everything GEL, GEL, because the world had abundant and cheap access to goods, energy, and labor. In the case of the goods and labor part of that had a lot to do with China coming into the World Economic Order in 2001, joining the WTO, massive surge in globalization, the flooding that China represented into the world of cheap labor, cheap goods, the US becoming energy independent. And for the most part, I think those ships have sailed. We have more geopolitical uncertainty, demographic profiles around the world have changed. We've kind of shifted from just-in-time inventory management and supply chain management to just-in-case. And it's not really deglobalization. It's rationalization, it's supply chain diversification, some nearshoring, some onshoring diversification, but it's a very different backdrop. And I think that that's just something to be mindful of, because I think what we might be entering into is an era that I've been calling the temperamental era, that maybe looks a little bit more like the 3 decades prior to the Great Moderation, from the mid 60s to the mid 90s, where you had more economic volatility, shorter cycles, more frequent recessions. But the other good side of that is your recovery phases were much stronger on the upside. You had more inflation volatility, which I think we're in an environment like that. That's not the same thing as saying inflation is going to stay high in perpetuity. On the inflation front, and now to tie in Fed policy, the pushing back on a March start to rate cuts was not at all surprising to us. We felt that there was a complete disconnect between what was going on in the actual data, the fact that the Fed just finished the most aggressive tightening cycle in 40 years, that there was no obvious green light to pivot to an aggressive rate cutting cycle. So the comments in the presser, on the statement, 60 Minutes on Sunday night, not at all a surprise. And I think it's in part because the Fed has always been seen historically as, I forget who sort of came up with the way of describing it, but it's a good visual, is they typically take the escalator up and they take the elevator down. They're a little more methodical and slow with tightening policy because of the obvious implications that has for the economy. And then once it comes time to loosen policy, often because they're trying to pull an economy out of recession, they tend to do more rapid fire on the way down. This obviously, so far anyway, has been the complete opposite. They took the elevator up, multiple hikes of at least 50, in some cases 75 basis points. And I think the inclination and the interest of maybe not repeating the Arthur Burns fits and starts, declaring victory only to see inflation reignite, I think they're more likely to take the escalator down. In terms of how this ties into market behavior, memories are always short in the market, and there's been so much of an obsessive focus on the Magnificent Seven and concentration in performance, and whether that's a risk, whether it's an opportunity. But it was as recent as the bear market in 2022, where the indexes were actually dragged down to a disproportionate degree by many of those same stocks. That was where the hits were greatest, because that's where you had some recessionary type conditions. It was only in 2023 that concentration became a big problem. Now I'd say concentration is less extreme. You've got now, through yesterday's close, not today's close, I didn't run the numbers through today, but looked at the Magnificent Seven, which, by the way, they're not even any longer the 7 largest stocks in the S&P. The first 6 are still the top 6, but 3 stocks have now leapfrogged Tesla. Tesla's in the number 10 spot, and you've got a few other stocks, including a couple healthcare stocks, and then Berkshire Hathaway, that have jumped above Tesla. But in terms of year-to-date ranking of performance, NVIDIA is still number 1, maybe no surprise. Tesla's the 502nd ranked stock. The S&P has 502 names. It's not 500 because Alphabet has two classes of shares and Berkshire has two classes of shares, but dead last. Even Apple is ranked 293. So it's sort of a lesson around not persistently looking at the market with a monolithic lens. You shouldn't do it at some, category level of the Magnificent Seven. You shouldn't do it at the sector level, which is why we have been much more focused on factor-based investing, actually investing based on characteristics, screening for, looking for, and we've been focused on quality. So quality factors like strong free cash flow, interest coverage, very important in this kind of interest rate backdrop, a good profitability profile, positive earnings surprise, positive earnings revisions, having a valuation mindset, and sort of looking at that quality grouping of factors and applying analysis across the board as opposed to sort of monolithic investing. The one thing, well, there's many things good about the return of the risk-free rate and the fact that we can earn interest on our savings, is that it also arguably has brought back the reconnection of fundamentals to prices, and not without volatility along the way, but I think it's a better backdrop for active money managers, stock pickers, and I think we're starting to see the demise of some of what may have been unintended consequences of the ZERP environment or NERP environment. And frankly, I think the Fed puts dead. I think their bias and other central banks' biases, maybe not ever, but not anytime soon, heading back to the zero bound. And I think that's a good thing. So I'll stop there.
Wonderful. Thank you so much. I want to thank all three panelists for fascinating kind of overview. I'm going to start out the Q&A with a question of my own, and then I'll get into the question. All three of you, in your own way, perhaps highlighted a central tendency which is kind of quite rosy and benign, but spoke about uncertainty, a fair amount of uncertainty surrounding those things. So what I wanted to ask you was, what do you think is the biggest risk to the forecasts or to the outlook you presented? And what are you looking at to see if that risk is materializing or not? What should we be paying attention to see if, just for the next surprise? So again, maybe we can go in the same order, Mark, Karen, and Lizanne.
Well, thanks, Venki. And I really thoroughly enjoyed the two presentations before. In terms of the risks looking ahead, I think there are risks on both sides, of course. If I were to pick a side of where are the risks bigger, I think it's that the economy continues to be more resilient, stronger. This feedback loop I was describing between consumption and the labor market continues. And when I heard Karen describing what she saw in the labor market, it made me even more worried about that as well. So I think so that has implications for activity, has implications for inflation, has an implication for the rates as well. And I think the risks are more tilted to that side, namely specifically in terms of rates, like a later rate cuts and also a fairly shallow cycle and certainly not rapid cuts. Now, we also know that when things turn down, when something breaks in the economy, it can break very rapidly, and it can lead to all sorts of different dynamics, these recessionary dynamics. It's just very hard to forecast whenever that's going to happen. I mean, something has to happen that is not in our baseline, is not in our typical forecast. Eventually, it's going to happen. With the consumer as healthy as it is now, it feels very hard to see this happening in the near term. But, some shock could happen that it turns this entire dynamic.
I will maybe take the other side of that. I'm glad, though, that I gave Mark a little bit of comfort. And it's what I said was absolutely true. We do see a pretty stable labor market. I think from my perspective, I am cognizant, as Mark said, that the risk that things can happen suddenly and unexpectedly. And I wonder, is it possible that the labor market will turn on us a little bit, and that, we go from the 3.7% unemployment suddenly moving upwards. I'm not particularly worried that we're going to end up at, say, a 10% unemployment rate or something in the double digits, but could we end up at 5 or 6% or more unemployment faster than we might expect? that I think is the risk for me, is that somehow we get a little, I'll say, unanchored in the labor market space, and there is a just, acceleration of layoffs. It's not what we see in our data. But if that were to happen, and I guess it would require the consumer to start to falter a little bit, then I think that's the biggest risk I see, and that we have a lot more unemployment than we've been looking at lately.
Yeah, I would agree that I think there's both sort of the upside risk scenario and the downside risk scenario, as has been touched on. Upside risk would be sort of the no landing scenario, which I think it was Mark that said, the market would have to start pricing in later cuts. Maybe, there's no escalator down, no elevator down. The Fed just doesn't leave the building, kind of stays in the penthouse, and everybody has to readjust to what the sort of terminal rate is, and you could see moves in yields, which, as we learned in the latter part of last year, can have a pretty significant impact on the equity market. Conversely, of course, there's always the black swan risk, the something breaking risk. We've gotten a little bit of a sniff of problems in the regional bank world with commercial real estate. I still think that that's more of a slow moving train wreck as opposed to a Lehman-esque in nature. But I would say, in terms of what to watch, high yield spreads have been incredibly subdued, almost to the point where, directionally they almost can't, the path of least resistance at some point has to move in the opposite direction. And when credit spreads start to move, they tend to move in elevator fashion, not escalator fashion. So that's where I think you might start to see signs that something is more awry in the economy. And that's, of course, leaving aside other black swans, perhaps of the geopolitical variety, which can always shock markets, at least short term.
Excellent. Great. So I'm going to pick up on a couple of questions here, the theme on a couple of questions. As you said, a lot of the uncertainty and a lot of the outlook depends on this turning point of the Fed. And all of you kind of alluded to that in different ways. But I wanted to kind of, what the questions were about is what's the scenario in which the Fed is cutting rates, right? Is this, part of Powell's speech last week, the presser last week, was to say something, there has to be a sense that something's broken in order for us to do that. And so, the reason I'm asking the question that way is an alternative view is to say that, the Fed has a restrictive monetary policy and just normalization would force them to take rates lower. So, can you kind of elaborate on what you see as the scenario in which the Fed starts cutting rates? Is it going to be a desire to return to more quote unquote normal rates, whatever they are, or is this going to be something which would require a fairly adverse signal on the economy side? So we're going to flip the order. We'll start with Lizanne, Karen, and then Mark.
Yeah, I think, and Powell made this fairly clear in an environment where they continue to emphasize data dependency, and by nature of being data dependent, they can't be transparent because they're not on a predetermined path. But he did do something that we expected, which is bring the labor market into sharper focus. Clearly, the up part of the cycle was driven more by inflation. It's not that they weren't paying any attention to the labor market side of their mandate, but clearly the aggressiveness of their policy tightening was driven by the aggressiveness of the inflation problem. He explicitly said that it's the labor market coming into play more. And the Fed is not trying to crush the job market. They're trying to sort of crush job openings without doing anything that leads to an accelerated move up in unemployment. And I think they don't believe that they have made enough headway on that front. So I think with each labor market data point, again, like I said, with all economic data points, you got to have your fine tooth comb. You got to peel layers of the onion back, whatever analogy you want to use, to get a sense of that connectivity between the labor market and inflation. I think that the reason why they push back on March is to pivot so quickly from the most aggressive tightening cycle to a cycle where the market was expecting a March start and 7 rate cuts. There was nothing in the data, even though, yes, with disinflation continuing, real rates have gone up, but those real rates being up are not restricting the economy. Those tighter financial conditions are not restricting the economy. So they're not really looking for something to break. I think they're maybe looking for something to bend.
I would agree with all that. It is, I didn't really say it explicitly, but it's our own view, not that the LinkedIn takes a view on the Fed particularly, but it's my own view just from my prior experience that I think the Fed will cut rates later in the year. I think they are really, to Lizanne's point, they are not interested in seeing unemployment like skyrocket, but they want to see that rebalancing. What would make them cut in apart from say trying to somehow target like what real rates are? You know, they might decide they want to cut, and you alluded to that, Venki. But apart from that impetus, I think also they are aware at how destabilizing capital markets can get, either because they're spooked by geopolitical issues, energy price, shocks, and or something that happens in emerging markets that just starts to cause a cascade of things that, shift capital flows around and shift rates and they bounce around. So I think those are things that are the classic shocks that cause the Fed to take a pause and say, maybe we want to kind of react to that. So that's possible. Those aren't my forecasts, but that's possible.
Yeah, and on our end, I think it's similar in the sense that, we, as part of our baseline, the baseline described before, we have like really a gradual moderation in the economy. As we said, the signs of that on the labor market, are still followed by question marks. I mean, it's still unclear as to whether really the economy really there is moderating. But basically, in our baseline, we have a gradual moderation of the labor market of activity. The Fed is trying to then, and the inflation remaining really low on the core PCE side. So in that respect, the real rate is we think that the Fed will view the real rate as being a little higher than they would otherwise be comfortable with, even though they don't see it in our baseline breaking anything in the economy yet. So it's in order to maintain these risks fairly balanced, I think they would be nudging their policy rate down, and they would do that in a fairly gradual fashion. So I don't anticipate any of the rate cuts along the lines of what we saw in the past. Like Lizanne was saying, take the elevator down. We don't expect that in the absence of like a big shock that would come that we don't foresee at this point. I expect them to really recalibrate essentially their policy stance very gradually by lowering the rate at a pace. I mean, we penciled in a pace of like 25 basis point every other meeting. So it's 25 basis point a quarter, 100 basis point a year, essentially. That's pretty much where we are at this point.
Hey, Venki, I wanted to just mention one other thing.
Sure.
When Karen talked about the Fed potentially stepping in if there's sort of rioting in the financial market, I think there's an interesting distinction there. And Powell, as far back as December 2018, when he gave the now sort of infamous speech at the New York Economic Club, where he sort of walked back on what he had said in September of 2018 that had led to a near bear market. But I thought the more interesting thing he said during that lunch, and I happened to be there in person, was that the Fed needs to distinguish between financial market volatility and financial system instability. They're not one and the same. And the Fed's mandate is not to heal financial market volatility if it's not tied to the risk of financial system instability. When you had the mini banking crisis, they quickly stepped in with the Bank Term Funding Program, their macroprudential tools. But I think simply, a heightened period of volatility or even a serious correction or bear market in and of itself, I don't think the Fed would step in if their mandates were not in support of that, or the financial system were not at risk of having kind of instability problems or plumbing system problems. That's why I said I thought the Fed put the way we think of it from purely a market perspective has been put to bed, at least for now.
Got it. Great. So the next question relates to, again, a theme which all of you touched on. One of the things that's kept the economy resilient is the consumer. And as Mark showed in his slides, that was partly buoyed by savings on the back of extraordinary fiscal stimulus in the aftermath of the pandemic. So the question that was asked is, how much do you expect savings or a lack thereof to impact the economy in 2024? And will a lack of savings be a significant factor in potentially a slowdown in 2024? And Mark, you teased us with more juicy stuff on household balance sheets, so feel free to use this question as a benchmark for that. So we'll go, Mark, Lizanne, and Karen.
Yeah, so I think there's a little bit of downside risk to the economy here, as I alluded to. The personal saving rate is now at a pretty low level, 3.7%. Last month we had data. This is pretty low, historically speaking. And now this, I should caveat that there's a lot of measurement uncertainty around that, a lot of revisions with these data and so on. But that said, this is what we have, and in comparison to historical experience, this is pretty low. So that, and I don't think that 3.7% saving rate is sustainable in the longer term. So that is to say that going forward, I would expect households to gradually let their personal savings move up a little bit. So for the same path for income, I would expect the path of consumption over time, not next month, the month after that necessarily, but over time, over the coming year, over the coming 2 years, I would expect consumption growth to be slightly lower than the income growth in order for the saving rate to gradually move back up to levels that have been seen as more sustainable over time. So that, I think, creates some downside risk to potentially to demand as a whole, and could limit some of the impetus that we've seen so far. Now, on the other hand, we've seen household wealth in the aggregate move up tremendously. No, that is not equally distributed, as we well know, but still, no, it's not just the top 1% that have seen a very big increase in wealth. It's a lot of all the individuals at maybe the top 20th percentile that have seen also a big increase in wealth due to the increase in housing values and things like that. So I think that is still supporting a fair amount of consumption going forward.
So I agree with everything that Mark said. I think that we, during the height of sort of the excess savings story, when everybody was still just flooded with excess savings, you actually saw it in a high savings rate. You could look at the consumer somewhat monolithically. And as I said about the market, I think the same should be applied now to things like consumer and impact of debt burdens. And at what point is there finally a crack that we see a waning in consumption? If you go down the income spectrum, that's where you no longer have any excess savings. That's where you see the more aggressive acceleration in the use of revolving credit or buy now, pay later. You can tie that to the subprime categories, whether it's for auto loans or credit card loans, and delinquencies are going straight up, but it's much more benign as you go up the income spectrum, out the net worth spectrum. So I don't think we should look at the consumer in any kind of monolith. I also agree that those metrics like savings rate, which in the past you might say would have put a halt to consumption, we've had pretty strong wage and income growth. So that's been a plus. There is that confidence in the labor market. I think more than just the cracks we've seen under the surface in the labor market, where those start to widen out, I think that could work its way through the psychological channels more quickly than what we've seen based on metrics like the savings rate. And then the last thing I'd say is, I think the stock market's a factor too, in terms of via the confidence channels. And if, God forbid, we were to get more than just, minor cracks in some combination of the labor market and the stock market, I think you could see sort of a clamping down on consumption fairly quickly.
Yeah, I think it's all pretty much been really well said. My perspective is that I actually share the perspective that Lizanne just expressed around the fact that lower income quartiles, I think, are experiencing what's going on differently than those who have been really exposed to, say, the Magnificent Seven, or heavily exposed in the stock market, or been homeowners for a long time and realized a lot of appreciation. I think it's, we haven't really mentioned housing, but I think there's a lot of different aspects of affordability that are absolutely weighing on folks who are like at median income and below. And I think it's more fragile than sometimes we realize. So for me, I would love to see, I actually think it's a good thing if the savings rate goes up a little bit at some point and renormalizes. But I also think that there's a little bit of fragility there around certain groups of the population, which are actually very large groups. And if they're as fragile as I suspect they are in terms of the reliance on credit cards, to Liz Ann's point, then I think there is some risk there.
Great. So one thing which I think I just want to pick up on something that Karen mentioned. So in the past, in earlier cycles, real estate and housing kind of often figured front and center in discussions of the consumer and outlook. And somehow, that seems to be less. We're talking more about the labor market than we are about, home prices and household wealth. And I think Mark briefly touched on that in his comments too. So I wanted to kind of engage you on the outlook for real estate, both as a contributor to the strength of the consumer, and perhaps on the commercial side as a source of risk on either on the financials or directly on that. So maybe we can start with Karen this time, Liz Ann, and then Mark.
So if it's okay, I'm going to make a comment, but I'm going to largely pass on discussing the housing market just for reasons I'm on a board of a company. But what I will say is I think maybe to my earlier point about the consumer and their various sources of wealth, I think that the labor market is extremely important right now because so many other aspects of the economy are sort of either stressed or not fully accessible to them. And so I think that whither goes the labor market is what's going to happen with this economy in 2024. I think the labor market is extremely important, but I'm going to pass on the housing question a little bit. And yeah, thank you.
Well, I'm not on a housing company related board, so I didn't when I was talking about the various dichotomies. I should have mentioned one specific to housing, which is existing homes versus new homes, and clearly unique in this cycle because homeowners, home buyers were fairly smart in this environment and really termed out debt and switched to fixed rate mortgages versus adjustable rate. So that's why the hit was nowhere near as acute as, say, what was going on in 2006 when the Fed was raising rate and pretty much every mortgage was not only variable, but it was all the absurdity of ninja loans. And there's just a very different backdrop right now. And the constraints in existing by virtue of basically, if you had a 3% mortgage, there wasn't really much incentive to sell and then have to double your payment. So it sort of stuck the existing market, putting all the action in the new home market, which is only about 15% of the overall residential real estate market. So I think that if, assuming long-term yields come down and mortgage rates free up, you do, I think, start to see some movement in existing homes. I think long-term, there's great opportunities. I think there's a need for building. I think this will be a growing part of the investment pie within GDP, maybe not very near term, given all the uncertainties that we have been talking about. But I think there are interesting opportunities for investment in not just residential investment, but business capital spending. I think the investment side of our economy is going to start to chip away a little bit at the discretionary consumption weight in our economy. But that's more of a secular story. But I think that new versus existing is, on the commercial real estate side, as I said, I think it's more of a slow-moving train wreck. Commercial real estate is a big category. It's not all offices. Even within offices, you've got Class A, Class B, big differences from one urban center to another. There are other categories within CRE that are actually in pretty decent shape. Obviously, the impact is felt more in the small and medium-size banks, but maturity schedules vary quite dramatically. So I think this is you got to look at each individual company to see what the risks are. And that's why I said I don't really view it as Lehman-esque in nature, that we're going to see some individual straw that just breaks the entire camel's back.
Yeah, and on the housing side, I totally agree with Lisanne. I mean, it's quite remarkable in 2022 when the mortgage rates went up from, let's say, 3% to 7% in the space of like a few weeks. We saw a big effect on overall activity. You could see immediately existing home sales like falling sharply. You could see new home sales falling sharply. You could see single family housing starts falling sharply. This is all in early 2022. And you could see also home prices starting to fall. But, by mid 22, late 22, that was over. It when home prices started moving back up. The new home sales started moving back up, and housing starts activity in the construction sector, in the housing sector, went back up again and has continued to move up so far. So I think there is a lot of truth to what Lisanne described with the lock-in effect of these high mortgage rates. People cannot buy. I mean, there's very little maybe demand for existing homes, but there's very little supply for existing homes. So all the demand there is due to the normal turn of like household formation and so on, or the people who really need to move from one place to the other, they are basically forced to go on the new construction market and new home market. So there's a lot of demand that's concentrated there. Then, the other factor that I think is really interesting is just before the pandemic, we already started with a fairly low inventory of homes to start with. And then people wanted more space and wanted more homes because of the pandemic. So that, we had relatively little house for sale at the time. We had not built much for the whole decade following the great financial crisis and the housing bust. So the beginning of the pandemic, we were really stuck with a fairly low inventory, and we still have a fairly low inventory. And so I think when we did some work on that, looking at the demographic factors and how that's going to affect the demand or the latent demand for housing going forward, it looks like for the next decade we'll have a pretty healthy demand just because even though the population growth may be slowing as the population ages, it requires more housing units, maybe smaller housing units, but it requires a larger number of housing units. So the demand for housing units is going to be pretty strong going forward for the next decade. So we are pretty optimistic there on the housing market. And on the commercial real estate part, I totally agree with what Lisanne said as well. It's more of a slow train than something that's about to collapse suddenly.
Great. So a couple of other questions had to do with the global picture. I know that's not necessarily what you guys focus on. So there were two parts to the question, and I'll let you guys pick which one and how much you want to spend on both. One asks about outlook for China and India and the emerging market space in general, and the other is whether the ongoing weakness in the rest of the world, the US in some senses, and perhaps the healthiest of the lot. So do you see the weakness in the rest of the world kind of spill over to your outlook for either US markets or US or the US economy or the labor market going forward? So let's go, Mark, Karen, Lisanne.
Well, real quick on China, I mean, I guess in terms of outlook, we're pretty pessimistic at this point. I mean, they have a whole range of issues. Demographic issues is one of them, but it's very long lasting. But on a more activity side now, confidence, housing, all sorts of issues that are a little concerning. India is very different, though. It looks like it's growing pretty rapidly, pretty strongly, pretty solidly. So that's a very different outlook. In terms of Europe versus US, we've both been subject to very sharp inflationary pressures. They've been more subject to energy price increases than we have. We have partly benefited from the energy pricing increase. For them, it's much less the case. And overall, I think the consumer is much, much healthier here. So in level comparison, there's no comparison. The consumer is just in so much healthier shape and growing much more robustly, which is not certainly not the case in Europe. So I think the outlook for Europe is it's rebounding from a weak point that we've seen maybe at the end of last year, but with a rebound that's pretty tempered compared to a still very robust and resilient consumption activity in the US that's powered by the consumer.
I would say, maybe from just a purely geopolitical perspective, I think the US is in some ways more insulated from some of the shocks that are happening. One example, there's some obvious geographical reasons, but there's also one example is that for example, the interruption to shipping that's happening right now through the Strait is more likely to affect European shipments than it is US ones that take a different route. So there's more risk to a European supply chain from what's going on than where we are here in the US. Another thing I would say is, and maybe with my LinkedIn cap firmly on now, we see a lot of dynamism in India. I was in Davos a couple of weeks back, and there was a lot of representation of different Indian states there, very much focused on attracting investment and business. And that's just a general statement from, with my personal perspective. But even in our own data, we see, we have an extraordinary number of our 1 billion members are in India. They are acquiring AI skills and advanced digital skills. And of course, this is who's on LinkedIn, so this is my lens. It's not the entire economy, but it is really a dynamic place where I think that they are kind of well positioned if everything goes right to really continue to see faster growth than say where China is or other really large economies. I think some of the larger economies in either by population or just by growth in LATAM, for example, aren't in the same place whatsoever. So I think India has really got a promising position right now. And in our own data, we see a lot of dynamism in the labor market, a lot of opportunity, and a lot of external companies willing to kind of set up additional shops there, which is, just speaks to a positive exchange of capital investment and labor.
Yeah, I'll be really brief because a lot of what both Karen and Mark said is very much in keeping with our thinking. We tend to talk about our biases at the broader index level as opposed to going country to country. And China, its sheer weight in emerging market indexes has made those less attractive in our view, even though there are tremendous opportunities in a place like India. So our bias has been a bit more on the developed international side. It's been a hard sell to get domestic investors to have an interest in having international diversification. I think the sell is getting a little bit easier, particularly if you're looking at equal weight performance sort of across the pond and equal weight developed international. MSCI developed international has done quite well relative to, in fact, outperformed the US in equal weighted terms. Japan finally seems to be pulling itself out of the deflationary spiral. You've got their market pretty soon likely to finally surpass its prior high, which was in 1989, which is really incredible. So I think that there are opportunities, but more on the DM side than the EM side because of the weight of China in the EM side.
Great. So which brings me to the AI question. So this is obviously something we can talk for a long time. This is implications for labor markets, for markets in general, for financial markets, and for the macro economy. So I'll let you guys decide how much you want to kind of, dive into this. But I think, your outlook for, U.S. labor markets or U.S. financial markets and this thing, the risks posed by AI, our markets, or are we kind of what kind of changes you anticipate from that? So we'll start with Karen, then Lizanne, and then Mark.
I have like a 45-minute spiel on AI in the labor markets. I will condense it to like a 45-second spiel. We've done a ton of work around this because we're really curious to see how does AI and generative AI start to show up in the labor market. I mean, the answer is it's early days, right? It's starting to, but it's definitely not all there. But here's some early takeaways from us just looking at particularly generative AI, because AI is already here. A lot of companies are already using it for lots of different reasons. One is that it does have the potential to create some job displacement, but our narrative is not around, oh, the jobs are going away. In fact, if anything, when we look at the fastest growing jobs on our platform, 2/3 of them didn't exist 20 years ago. So, without believing the point, like we think there's a lot of job creation happening too. And probably the bigger story around how AI is impacting the labor market is really that we think of it in terms of jobs being collections of tasks. These tasks are performed because you have skills. So the skills are rotating. Generative AI is going to take over some of those tasks because it can replicate those skills. For other skills, it cannot. So the jobs that have a high proportion of skills that only humans can do, they're less likely to be touched. I mean, eventually they'll be affected, but there are other jobs that are at risk. And so it's really a question of you rotating in whatever occupation you're in towards finding a way to let AI be or generative AI be a partner or productivity enhancer and not something that replaces you. We actually think we're going to stay in a knowledge economy, but we're also going to be tilting towards the relationship economy, the human side and the people skills. So last thing I'll say is we're actually seeing a massive demand for AI talent across all industries, which tells me that the adoption is happening. It's not just tech. It's not just manufacturing. It is literally every single industry is looking how can they leverage generative AI. So we think it's happening. We do see it happening faster in certain countries like Israel and India and Finland and Ireland, faster than maybe say other countries like Italy, for example. But we see it happening everywhere. And we think almost every job will be touched by generative AI. Right now, it's sort of a wave and a hype cycle, but I think ultimately it's going to be part of all of our workplace experiences.
Well, I'm not at the point of being able to do 45 minutes on. So by virtue of not having the long story, mine is the short story. But one interesting theme, and it's really come to light, I think, during this earnings season, because it's the season where we're hearing from companies. And it's not just about what did you report for last quarter, but the conference calls are interesting and it's about outlooks. And I think last year was more about kind of the creators of AI. Now I think it's more the users, the utilizers. And Karen, to your point, this is everywhere. Every company, every industry, whether you do natural language processing, or you do word clouds, you look at transcripts, there is not a company that, even if they opt not to mention it up front, that don't get asked about how you're bringing AI into the mix, either to change the nature of how you work or to enhance productivity or efficiency, whatever the reason. I think the story is much broader now, and it's about how everyone, every company across the span of industries is going to utilize AI, what investments they plan to make, and how quickly and directly it's going to impact their business.
Yeah, I'm also not sure I can talk for 45 minutes about AI, but let me I totally agree with what both Lisa and Karen said, that looks like it's happening in many places. The diffusion is taking place. That seems to be taking place, absolutely. Now, does that mean that because we've seen productivity or labor productivity move up, 2 quarters in a row at a faster pace in the US economy, that this is the effect of AI? I'm not convinced about that. I mean, I tend to think, and this is not to say that AI is not enhancing productivity. Of course it is. And I'm sure it will at some point. But whether we see it at the aggregate level in national income accounts, I'm not sure that we are at this point yet. And here I'm thinking about a lot of the work that has been done by people like John Haltingwanger and many others, academics looking at the diffusion of productivity and how that works. I mean, generally, as I understand it, when you have innovations of this kind, it leads to a lot of dispersion across firms. You have some firms that are incredibly productive and adopt the technology right away, and they have a lot of productivity gains, but many other firms that do not. And then it takes a while for this to diffuse, across the whole spectrum of firms. And then you have the firms that do not, that over time disappear. And then the ones that have adopted the technology stay on. And then you have, after several years, these gains in productivity. So I do believe that mechanism, I suspect this mechanism is at play and will be at play. This is in line with a lot of anecdotal evidence that I hear, but I don't have any way to quantify this at this point. I'm just don't, the question I get a lot from people I interact with on a regular basis is like, is AI going to help us bring the inflation down? Yeah, maybe eventually, but I don't think that this is solving this year's inflation problem that we have. And this is not the reason that the Fed is going to necessarily cut rates this year. So that's just a question of like a horizon.
Could I just add on to that really briefly, Venki? Sorry, I really agree with what both my co-panelists said, and I just wanted to add on to Mark's point. There is a huge divergence between what you see among companies. Some are leaders in this, some are laggards. Big companies are a little bit more sophisticated, but they're all figuring it out. And it definitely is. I would just want to say, I think we're at the very beginnings of a journey before we see all this show up in, national accounts in some way.
Excellent. So one other question, and I think one of the theme that I want to pick up on, and that has to do with the fiscal side. And I think, how does the fiscal outlook factor into your outlook for markets or the economy? If you want to call the 2024 election, I'm all ears. But I think more generally, how do you see that as a risk, as a factor? Is this going to be a major risk? Are there going to be headwinds from the fiscal side? Do you see, an increased emphasis on industrial policy as being a kind of a boost to the economic outlook? So let's go in Mark, Karen, and Lizanne.
I think on the fiscal side, it's really hard to pinpoint really how much of the fiscal stimulus has contributed to activity in the last few years. Just because I don't think looking at just the G component, government spending component in the national income account is going to give you a full representative view of what happened. As I try to allude to, much of the support for consumption, I think, at least in the early days of the pandemic, happened through government transfers and, fiscal support in one way or another through unemployment insurance or other means, the checks that we got. And I think this shows up in terms of consumption. And then we had a lot of incentives, whether it's the CHIPS Act or the Inflation Reduction Act and all that lead to a lot of construction activity now for future manufacturing plants. Karen, alluded to that as well. I think this creates a lot of activity, a lot of jobs that is related to fiscal policy in some sense, but although it's not direct fiscal spending necessarily. So I think it's hard to really measure accurately the extent to which we've benefited from or been affected by this fiscal support. Now, that said, this also came with, if you look back over the last year or the last fiscal year, we had essentially a $2 trillion deficit. Once you account, you clean up for the accounting related to the student debt loan that were never canceled. Effectively, the deficit went from $1 trillion in the 22 fiscal year to $2 trillion in the 23 fiscal year. So a doubling of that fiscal deficit. And it looks like we're going to have another very large deficit this year, maybe 1.6, maybe 1.7 trillion. So very, very large fiscal deficit again. And this is without having even a recession, having with a pretty solid economy, pretty solid income growth, and pretty solid consumption growth. So it looks like, and I think Chair Powell said that as as recently as Sunday night, I guess, the fiscal policy is not on a sustainable path. It was not on a sustainable path back in 2019. It's still not on a sustainable path now, and now it got worse. It got worse because the interest payments on the debt are a lot larger. So yes, we'll have to do something about that. That will require some amount of fiscal tightening one way or the other. Fortunately, it looks like whether we have, one party or the other in power, if these parties are fully aligned, meaning President, House, Senate, it doesn't look like one is going to really reduce the deficit a lot more than the other. It looks like, if we have a perfectly aligned government, we might be in for a little more spending or a lot more deficits, should I say, going forward for some time until we get to the point where either market forces it or we have Congress really planning to bring this under control.
Oh, am I next? Well, I don't think Congress is going to wake up one day and find adults in the room on both sides of the aisle to sit down and have an honest conversation about this. So if they're forced to do something, it'd be because the market forces them to do something. For now, yes, the interest on debt is going up, but it's not extreme relative to history. Obviously, looking ahead, we've got to have an assessment of the interest rate trajectory. For now, with the additional issuance, there has been ample demand, and there had been grave concern about that in the absence of the Fed no longer being the largest buyer of treasuries. There's been ample household demand that could potentially change, but I don't see either side actually addressing this. I mean, the real solution to this problem of the high and ever-rising burden of debt is to have debt growth at a lower rate than economic growth. That's simply the point at which you start chipping away at the problem, and that doesn't seem to be, frankly, a mission on either side. So I'm an equal opportunity critic of Washington on this subject. I can't believe that Congress has a 10% approval rating. Like, I want to know who the 10% are that think they're doing a bang-up job.
Maybe I'll round it out by just sharing a little bit of our data. So we definitely saw the power of the fiscal policy impetus show up really, really quickly. So an example, of course, was what I mentioned earlier around construction and manufacturing roles that just suddenly proliferated with a lot of new projects. We saw a lot of interest in like electric vehicle and electrical grid type roles, a lot of demand also for like sustainable and green roles. And all of this was related to elements of fiscal policy that started to create space for this to happen, for money to be spent or people to be hired to be focused on these questions. And then finally, I would also just say that in our data, what we saw was state and local government coffers were pretty full at some stage, and I think they might still be. I haven't checked recently, but yeah, I'm getting the nod, so I guess they still are. And that also gave a lot of room for a lot of hiring. So it was an interesting kind of counter-cyclical trend where as some employers were sort of scaling back, maybe at different scales, but scaling back on their hiring, we saw the state and local governments really stepping in, hiring everything from like, crossing guards and school bus drivers to librarians and so forth. So really lots and lots of hiring at the local and state level, probably from fiscal policy.
Thank you so much. So for my final question, there's a lot of students in the audience today, and the three of you are role models for all of us. So I wanted to, if you could take 30 seconds and just give them, all of them are at key kind of inflection points in their careers. Some of them are just starting out, others are switching careers. So I just wanted to get, your perspective, your advice for them at this stage in their lives. So let's go, I don't know, Karen, Lizanne, Mark.
Okay, so my advice is don't get too hung up on having some 10-year plan. I mean, obviously, I tried to have one too. None of my 10-year plan worked out. I'm still pretty happy with my career. And a lot of the opportunities that I ended up taking were not ones I could have envisioned when I was finishing up my school. So I just want to give you a lot of encouragement to trust in yourself and enjoy the learning, and a lot of good things hopefully will come your way.
In a fun way, I'll reiterate what Karen just said by quoting Yogi Berra, when you come to a fork in the road, take it, which I think that's silly, but so brilliant. And then the other thing I say to particularly young students who are maybe coming into the working world and starting the interview process, everybody seems to be so focused on making sure you're interesting to prospective employers. Be interested. That matters more than being interesting.
Love that. I would say that be curious, be patient as well. I know I have kids who are in college or just went to college, and I know how sometimes patience is something that a skill or virtue or however we want to characterize that is not so frequent to observe at this point. But I would say be curious, explore a lot of things, and be patient. And if you keep doing your job and you show that you have a skill, and that people see that you take ownership of what you're doing and you're bringing it to the end, you're going to get rewarded. So that would be my piece of advice.
Wonderful. So on behalf of everyone on the call and everyone at NYU, I want to thank our distinguished panelists. This was a fascinating, 90 minutes. We could have, used a lot more of your time, but I want to be respectful of that. So I want to thank you all for coming and sharing your wisdom with us. And I want to thank all the audience for participating and making this even more engaging and interesting. An interesting session. So I look forward to seeing you all at future events. And with that, I'm going to bring this session to an end. Thank you all.